Hi, this is How I See It. I saw this movie yesterday, The Big Short, and I really liked it. It was very well acted, and I was especially very happy to see a lot of truth about the reality of the crash of 2008. I'm going to play just the beginning of this here for you, this preview.
Banks have conditioned us to trust them. What have we gotten from that? 25% interest rates on credit cards. They have screwed us on student loans that we can never get out from under.
When the banks commit the greatest fraud in U.S. history,
no one is paying attention.
It's unbelievable. 4 outsiders risked it all to take them down.
We're going.
Okay, so it's obviously about the collapse. I just said that. One thing that this movie, one shortcoming of this movie was they don't talk about the Federal Reserve at all. The Federal Reserve is a bank. It is a private international bank. And they also did not connect the banking establishment with the government because they're all owned by the same bunch of filthy rich, scumbag, mass murdering bankers who are European. The thing about that movie that for the characters in the movie basically made them come to realize that everything was going to collapse was collateralized debt obligation, CDOs. This is the definition: a structured financial product that pools together cash flow generating assets and repackages this asset pool into discrete tranches that can be sold to investors. A collateralized debt obligation is so called because the pooled assets, such as mortgages, bonds, and loans, are essentially debt obligations that serve as collateral for the CDO. The tranches in a CDO vary substantially in their risk profile. The senior tranches are relatively safer because they have first priority on the collateral in the event of default. As a result, the senior tranches of a CDO generally have a higher credit rating and offer lower coupon rates than the junior tranches, which offer higher coupon rates to compensate for their higher default risk. I know it gets confusing. I totally understand. This movie outlined CDOs as, well, in this way. 2 people are betting on something. Behind them, 2 people bet on their bet. Behind those people are more people betting on those people, betting on the initial bettors. And then you have more people betting on the betting people, betting on the betting people, betting on the bettors. Do you see what I'm saying? And it goes way down the line. And all this one bet turns into a long line, probably of millions of people betting on the same one single bet. So like you saw with the little making those blocks collapse wherever they are, I can't find it. Anyway, that's what happens when that thing collapses, and that's what happened in 2008. So for me, when they put that movie out, it's a sign of them telling us and warning us, just as they do with their magazine cover on The Economist. This was the 2015 one that many people are talking about, and I believe that it is a message for sure, because you have to remember, The Economist is not a random newspaper that publishes quirky 2015 predictions to sell a few additional copies. It is directly connected to those who shape global policies and who make sure that they are applied. The publication is partly owned by the Rothschild banking family of England, and its editor regularly attends Bilderberg meetings. In other words, The Economist is connected to those who have the means and the power to make predictions a reality. So, these are signs, these are their little ways of telling you what's going to happen, what's coming down the line. And of course, it doesn't look so good, does it? Back here you see a mushroom cloud from a nuke. Okay, There's a lot in here. I'm not going to get into that. But the point is, this movie, I think they allowed it to even happen because it's just their way of warning people. A lot of you might not think that people warn, or that they're warning us about anything, that they wouldn't do that. But I think it was Lindsay Williams, who supposedly has an ear to the elites, said that it's sort of a moral code with them, which of course is rather funny coming from them, that they have to somehow warn us, which is what all that stuff is embedded in TV shows and movies, you know, like all the 9/11 stuff in Back to the Future and The Simpsons, etc., etc. So, what are other signs? Well, there are plenty of signs, and I'll link to this, and you can go back and read this. This is from last year in April, and there has been much more things happening since then. This might seem like a non sequitur, but this is more evidence of things coming to pass, or rather evidence that things are being manipulated. So, silver. Let's talk a little bit about silver. What is the London Silver Fix and why is it going away? The London Silver Fix is a daily price benchmark for the silver spot market. The fix is set during a conference call at noon London time between Deutsche Bank, HSBC, and Bank of Nova Scotia. During the call, the banks exchange bids and offers for silver on behalf of themselves and their clients, declaring the price fixed when supply and demand is equal at a certain price. That is the definition of a free market. Okay? The price is based on the buyers and the sellers. So, let me continue on here. I'll just tell you, this is Kitco. I'm going to refresh the screen. You come here daily. They update it daily. Or, yeah, for gold and silver. Here, silver is at 1522 bid, 1532 ask. Now, in January 28th, there was a flash crash of silver. It went down all of a sudden. What was that about? Well, first of all, I want to read you this. In part due to the agitation of the gold and silver bugs, government regulators came down on the market makers. They fixed it so that market makers were no longer allowed to arbitrage the fix to the spot and futures markets. Before you think, yeah, this is what we want, let's revisit one of our favorite and recurrent themes, namely, be careful what you wish for. As it stands today, if the fixed price is starting to deviate from the market price, the market maker's hands are tied. Ross Norman, CEO of bullion dealer Sharps Pixley in London, expressed his frustration with this. The real problem, as we see it, is that banks are increasingly unwilling or unable to place corresponding orders where they perceive a mispricing because of fears of being accused of abusing a situation and facing the wrath of the regulator or their compliance departments. The big clients who participate in the fixing process may be freer to trade. However, they don't have the same information. Market making is hard because you're playing for pennies or fractions of a penny, but if you screw up, you can lose dollars. The clients may know how many rounds into the fixing process they are and the order imbalance of each round, but they can't react as quickly as the bullion banks who are making markets in the spot futures and ETF markets. And they don't know as much about market conditions either. They can't arbitrage a few pennies. They need a much bigger spread. A wider spread, much less an unpredictable spread, is to no one's benefit. For example, the mining companies often sell at a fixed price. Rather than try to time it or be accused of breach of fiduciary duty by their shareholders if they mistime it, how much deviation of the fixed price will it take before miners are forced to embrace the next best solution? The large discrepancy between the spot price and the fixed is very alarming to us, especially that it happened twice in a row. These are two scenarios that the silver doctors are presenting that they think could possibly be the cause of that flash crash. Scenario 1, as I just mentioned above, it is possible some bank, broker, or other entity needed to settle some sort of contract under $14. It is possible this fishy fix enabled someone to close a short without any pain. It may have been an accommodative trade, so to speak. What he's talking about here is manipulation of the price of precious metals. Scenario B, this may have been margin liquidation, meaning someone was long silver but received a margin call from another market that needed to be met and very sloppily liquidated all at once. I have a feeling it was more scenario A, because that's what these people do. They manipulate the markets to their benefit, and they have been doing it. Manipulation of precious metals is worse than the LIBOR rigging scandal. It may be time to shift yet another conspiracy theory into the fact bin, thanks to Elke Koenig, the president of Germany's top financial regulator, BaFin, which apparently is not as corrupt, complicit, and clueless as its US equivalent, and who said, in addition to currency rates, manipulation of precious metals is worse than the LIBOR rigging scandal. Also said was that the issue is causing such a public reaction is understanding. The financial sector is dependent on the common trust that it is efficient and at the same time honest. The central benchmark rates seem to be beyond any doubt, and now there is the allegation they may have been manipulated. Trust me, they are being manipulated. Silver and gold should both be much more valuable than they are rated right now. Top 10 countries and their gold holdings. This should be a wake-up call to anybody who thinks that precious metals is just a joke, because that is exactly how the bankers and the government presents the idea of owning precious metals to you. India has 557 tons, Netherlands 612 tons, Japan 765 tons, Switzerland 1,040 tons, China 1,054 tons, Russia 1,149 tons, France 2,435 tons, Italy 2,451 tons, Germany 3,384 tons, and apparently they're telling us that the United States have 8,133 tons, the most gold than anybody else. I don't believe it. I think it's a lie, because I think that the powers that shouldn't be are actually very actively engaged in destroying America. So why would they have so much gold? These countries, India, China especially, are going to be very powerful, I think, when this all comes to end after the crash. What this should also tell everybody is that the governments are hoarding and buying gold like crazy. So what do you think that means? Do you trust governments? No. Why? Because governments do only what they need to do for themselves. They are self-serving. Believe the news that you don't hear on mainstream media. Don't believe the news that you hear on mainstream media. They are not telling you to get precious metals, because you should be getting precious metals. And it is not spending your money on gold and silver. It is exchanging worthless bankers' scripts, blood money, into something that has been around for thousands of years and has never lost value.